If we can understand our relationship with money, for myself, I was a big saver. Immigrant family, I was a hoarder. Saving is great, but there's a scarcity mindset. Once I understood save the money to buy an asset that pays for my events, and I continue to have that asset.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back. Another episode of the Apartment Gurus, and we have one of the OGs in the house, as they say. If you know multifamily, if you know syndication, and you're especially in the GP operator space, and you've been around anything in the way of podcasts or books or conferences, you have run across Gino Barbaro, a true titan in the thought influencer space and in the multifamily space. And Gino, we were talking before we started recording. You were last a guest on the show in August of 21.
Yes.
So hard to believe. And I can't wait to kind of catch up with you, because it's just, I mean, not a whole lot more could have changed than did change in that amount of time between, you know, we're recording this mid-November of 24. So, but Gino, just first of all, great to see your face, man. It's always a pleasure to get to be in your space and hear what's up with you, and welcome back to the show.
Tate, I just want to say thanks for having me on. And that word guru sometimes gets a negative connotation. Yeah. So what I like to call ourselves, Jake and myself, was we're the Durus.
Durus.
We're not only out there teaching it, we're actually doing it. We're closing around 300 units a year ourselves with our own capital. We have a pretty, extensive Jake and Gino multifamily community. And it's something where I think you're doing the investing. And we started this whole Jake and Gino community because we both had left our jobs. We had several hundred units. I personally wanted to become a much better investor. And how do you do that? You do that by learning it, then by doing it, and then ultimately by teaching it. Because as you're teaching it, you're on these podcasts every week, you're going to seminars, you're going to events, you're coaching people, you're learning what's working for them and what's working for you. And you put all that together, Tate, and that somewhat becomes magical. It really helped us out over the last 3 or 4 years to become better operators in the space as well.
Yeah, the old adage is, if you want to really learn something, teach it, or something along those lines. And, yes. I've always, especially since having you as a guest on the show, but also going to what was back then. Is Money Mastery still happening?
Multifamily Mastery.
Multifamily Mastery. MM.
Yeah, we had our last one in MM6. And Tate, what I'd like to do right now for the listeners, I think it's important. Let me take them back to where I started investing, because I think history tends to repeat itself. And right now, where we are right now, to me, it seems as if is when Jake and I started. Jake and I started in 2011. It took us 18 months to find our first deal. So in 2013, we closed our very first deal. And we have short memories. But back in 2011, it was very hard to raise capital. Is that going on right now? Absolutely. It was hard to get debt back then. Absolutely. The only difference, and it's going to happen, is there were a lot more deals back then. And there were deals because nobody was buying them, because the interest rates were around 6%. The economy sucked. Rents were really low. I mean, valuations are low. There was just no demand for the asset. Yeah. A little different now, but those two other stipulations occurred. As we got longer into the market cycle, 2014, 15, 16, 17, it became more popular. The Jobs Act of 2017, I think, changed a lot. It made raising capital a lot easier. You have bonus depreciation. Asset starts taking off. Then the Fed, in their infinite wisdom, keeps interest rates really low. We get private equity jumping into the game. Then 2020 comes, where there should have been a recession, because that's about the 10-year. It's about 10 years between peak and trough. COVID happens. And all of a sudden, they start pumping in trillions of dollars. And it artificially keeps the real estate market up. And you have low rates, tons of money. We can't find deals in 21, 22. We do about maybe 100 units total as 2 years. It was very difficult. 2023, we had a breakout year. We did 300 units in 23. We've done 300, about 180 to 200 units this year. But if you look at the horizon, we're coming back to a period right now where I feel as if we may go back into that 2012, 2013 trough. I'm waiting for the banks really to rip off that Band-Aid and say, hey, we're not extending anymore. We're calling your loan. And I'm waiting for all the appraisers to come in and really set valuations at 7 and 8 caps where they should be, but they're not doing that yet. But when they do that, the floodgates will open. And my last bit of advice before you ask the next question, which is really important, if you're thinking about getting into real estate, now is the opportune time because brokers are calling you back. You need to create the relationships. If you wait and everything crashes and the deals come back, the brokers are calling Tate and they're calling Gino because we're on their list. So don't be afraid that right now you're waiting for the market. Don't wait. Now is the time. If I had said that back in 2011, well, now is not the time, I never would have gotten into it and it would have passed me.
Lot to unpack there. So just sticking with now is the time in your eyes. If what you say, for those of us that bought in 21 and 22, like my company, when you weren't buying, what you just went through isn't exactly great news because what you're predicting or waiting for, in your words, in terms of appraisers decompressing cap rates and banks calling notes due. That's a little different because if you're in that situation or not. But cap rates are one of those things that are global. You can't control them. Do you feel that when you say now's the time, is it now is the time to prime for 6 months from now, 12 months? I know you don't have a crystal ball, but in your model, in your eyes, is that what you're seeing, or are you guys pencils down right now? I guess is another way of asking.
No, we're pencils up. And I think people need to understand that real estate is a long-term play. You can always buy real estate in any part of the market cycle. You can't always sell real estate. But if you're thinking about planning on getting into it, I always ask people, where were you 5 years ago? Do you wish you had bought real estate 5 years ago? The answer is probably 99.9% of the time. Yes, I wish I'd bought real estate in 2019. Now let's forward to 2029. You're 5 years out into the future. You wish you'd bought real estate back in 2024. The answer is going to be yes.
Yes.
It's just understanding the framework of buy right, manage right, and finance right. Now, where people had issues, they were buying deals in 2021 and 2022 that were stabilized. They were buying them on bridge debt. Bridge debt isn't bad per se, but let's see what was happening during those 2 or 3 years. We had labor shortages, we had material shortages, we had, assets that were overpriced, and we had low rates. And then you couple that with time horizons where you only have 2 or 3 years to turn these properties over. And then, oh, by the way, you buy rate caps, but then interest rates just triple from where you were. That really hurts. Now, a lot of these people had been able to buy these assets on stabilized debt where you have at least 5 years or 7 years for that bridge. We've been using credit unions and community banks that have 5 and 7 years. They have a term, but it's much longer. When you're under pressure in real estate to do something in a specific time period and that runs out, that's when you lose money in real estate. There's two ways. You either run out of time or you run out of money. And a lot of those investors are running out of time right now. And we've been preaching, Jake and myself, be careful with bridge debt. If you're not experienced and you're trying to make the deal work and you're forcing the deal, that's what we saw. And, that's where we were in the market cycle. Low interest rates, cheap cost of capital. When you look back, rates were 3%. That was ridiculously. So you're able to pay more for that asset. But then when you put a time constraint on that and you're only able to work with it for 24 months, when that time period comes up, you're sort of stuck because no one could have conceived that the Fed would shock the industry by raising rates 11 times, the quickest in history. That really shocks the market. So if you're asking me what I think is going to happen the next 3 to 4 years, I think the supply coming back online is going to stabilize. I think we're always going to have an affordable housing shortage. There's not enough assets being built, specifically where you need them built, like in California, like in New York, because the problem is there's so much regulation there. So if they can continue to build, and we need to build assets, because the only way you get rents under control is by building, by having more supply. Not going down a rabbit hole, but it's still cheaper to rent an apartment in the United States than it is to own. So that's a bonus for us in the rental industry because we can still supply these homes. But long term, the demographics look great for the apartment industry because you have more people renting, less people owning homes. It's cheaper, and it's just more of a housing situation where, like, hey, I'm a 33-year-old millennial. I don't need to buy a home right now. I don't have a family. I may be in Seattle one year. I may be in Tennessee the next year. Why would I buy a home?
Mm-hmm. Yeah, makes total sense. Changing demographics in that way are huge, and then you throw in an existing housing shortage on top of what is, in certain parts of the country are predicted to be, a fair number a fair amount of shortages on the housing start count, so to speak. I know, for instance, in Columbus, they want about 19,000 units a year to keep up with demand. They're hitting about 13,000 a year in a push year right now, and then the starts for next year I think are about half of that. So, like you said, it's certainly, obviously everything's local in real estate, and it's certainly market specific. But when you look globally at this market, it's such a unique market. I mean, it's an incredibly rich time, I guess, to be in our space.
Tate, you made a good point. Before you skip on to the next point, this housing starts in multifamily cratered in 2023. Once the cost of capital shot up, those permits just disappeared. I mean, they have gone. So you're still seeing the supply coming online because that was basically in 2020, 2021, those starts. They're just coming online right now. And once again, let's go back into our history lessons. In 2008, when we had that big ass recession, they stopped building for 3 or 4 years. There was no activity, but you still have a lot of immigration. You still have a lot of household formation. So they're catching up from the last market cycle. And now that you've had interest rates, go as high as they have, housing has stopped. So for this train to get back on schedule right now, rates are going to have to drop. Housing permits are going to have to go back up. That's another 12 to 24 months, you're out at least. So you're going to have supply come online. It's going to stabilize. Rents are going to start going back up in the next 12 to 24 months after the stabilization. So just be wary of that. And like you said, you made an excellent point. It is local, but if you're in a market that is expanding, that does have population growth, hopefully you are, that has job growth, you're going to see those demographics and those metrics play out, and it's going to be positive for you going forward.
Yeah. Let's switch gears a little bit to the equity space and whether that's your retail level investor, your LPs, your private equity. Obviously, that game has changed a lot, and I'll just share real quickly in a nutshell that our LPs, we have about 75 active investors in our deals, and I'll be real with everybody on the air, including maybe some LPs that are listening. They're not re-upping right now, and I don't blame them. Quite frankly, we've gotten stuck in a few deals, and I don't mean that sounded like a victim. We put ourselves in a few deals that a few different things have happened. One is we just haven't hit target rents that we had underwritten, and so we're not cash flowing where we thought we would be in order to pay a preferred return that we had projected, right? And so when you see that as a passive investor, that's not necessarily appetizing. And in some ways, we can look at that we're weathering the storm, right? We're not, as of now, we're not doing capital calls. We're not looking at losses, right? But still, as an investor, you're going, like maybe this fad from 21, 22 that we were all jumping into isn't really worth jumping into now. And so, we've had 4 deals in a row now that have been brutal on the limited partner side. On the private equity side, they've been brutal because they've been too small. Most people know private equity wants to start at a minimum of 5 million on a check size, and 10 million makes it a lot better. Your chances a lot better. So, Gino, from what you're seeing, what you are coaching and teaching somebody coming into the space around raising capital, like what does it take these days?
Tate, I'm going to get on my soapbox right now for a minute. And LPs need to, they need to hear a little bit of loving right now. Nobody was complaining back in 17, 18, 19, 20, 21, 22, when they were getting those fat checks, right? And they're rolling that money into the next deal. Everything was great. Nobody wanted to learn the space. But when 2022 comes, LPs, they're still investing, but they don't know how to underwrite a deal. They don't know how to underwrite a sponsor. They don't care about their interests. They just want to put money into real estate. I'm trying to teach people to invest passively right now, and nobody wants to know. Nobody wants to learn how to underwrite. And I shouldn't say nobody, but the vast majority of limited partners, they think it's the stock market. The first thing you need to understand as a passive investor in real estate is you need to understand that it's a business. It's an amazing, lucrative, scalable business, but it's still a business. And we teach our 3-step framework for passive investors. What passive investors do, first thing they do is, I need to find a deal. What's the best return? That's the last thing you should be thinking of as a passive investor. Don't worry about the deal. Worry about the jockey or the sponsor. That's the first thing. You know, the jockey, the guy who rides a horse, that's the first thing you should be focusing on when you're investing passively. Find a sponsor who's been in the business for a while, who understands and can run their business plan and explain it to you as if they're a 7-year-old. The second component to that is what we call the saddle that the sponsor sits on, or the alignment of interests. Do my interests as a passive investor align with the sponsors? And that goes in many different fashions. If I only have 30 or 40 or $50,000 left to my name, and that's all I got left, and a sponsor comes over and goes, guaranteed, you're not going to lose your money. You run, because real estate is risky. And that sponsor should be telling you, yeah, there is risk in this. I would never want to take someone's last $50,000. But that's not how it was being played for the last couple of years. But passive investors don't think of that. I want to know if the sponsor has any skin in the game. Do they have money in this deal? And I'm only coming from this as a place of love, because I've made all of these mistakes. In 2006, in my first investment as a passive investor with somebody who was actually, it wasn't even a passive investment. It was supposed to be a joint venture, but it was a syndication. I just didn't know. This dude took my money. He had no skin in the game. When we lost the deals, he just walked. All right. I didn't understand the business itself. I didn't know how to underwrite the deal. I never flew down and looked at the deal. I never did due diligence on the deal. So it was my fault, but I didn't want to admit it. And that's what passive investors are going through a little bit right now. They need to take a hard look in the mirror and say to themselves, what mistakes did I make? Because I want to continue to invest in real estate for the long term, but what mistakes should I avoid? And I'm telling you, looking at the sponsor, understanding and learning the business as if you're going to do it actively, but you're not going to do it actively. You're going to do it passively, but understanding how to select markets, how to read a T12, how to read a rent roll, how to do an underwriting, how to understand when a sponsor sends over a deck and a presentation, how to poke holes, how to look at the sponsor's team and say, well, I don't like that syndication attorney or that property management company. They're terrible. How to be able to look at a deal as if you're actively doing it, but then you're actually just sending the money over and letting that team. And so the first two, like I said, was the sponsor, then your alignment of interests, and the third one, now that you like the sponsor, now that our interests are aligned, I've got money. He can have this money for the next 5 years because I'm not getting it back. It's an illiquid investment. I understand that. They have some skin in the game. They're invested in it like I am. Now let's look at the deal, or the buy right, the manage right, and the finance right. So if you're looking at it, investing passively, and you've made some mistakes over the last couple of years, one thing I'd like to say, what we didn't expect in our space is expenses. There's a lot of deals in the Southeast here where insurance has doubled and tripled. You can't underwrite for that. I mean, it's very difficult, where property taxes have exploded, where labor's exploded. Even if you've done right and you've hit your rental income projections and you've hit all your other stuff, those expenses can throw you for a loop. So if you're out there and you're a passive investor, I want you to look at it from that framework and spend some money on your education. Go out there and find a coach. At the very least, if you're going to be looking at deals and putting offers in on deals and you're not really sure about the underwriting, go out there and find a consultant who can look at the T12 and the rent roll and the underwriting and poke holes in that deal. And it's not the answers you're looking for. It's the questions that you need to ask that sponsor, and that'll give you the answers. We're always worried about, can he answer this? No, what's the right question you need to ask that person? And using a consultant to help you invest in these deals will protect your money and protect your future.
There is so much in there that I've never heard before. I mean, there's some really specific things for LPs to be doing. And all through that, I'm going, well, and I can hear a listener going, It doesn't sound super passive, Gino. It's like,
you know what? That's a great question. It may not be super passive in the beginning. If this is your first investment, this is what I would recommend people, because I was stuck in the situation. If I had done this on my very first deal with, I call him Maserati Mike. He pulled into my parking lot at the restaurant driving a gold Maserati. He comes in, he talks to me about the deal. I actually end up investing $172,000 with Maserati Mike. That money vanished a year and a half later. If I had just said to myself, Mike, let me jump in a plane. It's a $500 plane ticket, one day off of work. Let me go tour the properties. Let me see what's going on. I would have flown down there. I would have gone into those mobile home parks. Not that mobile home parks are bad, but these were in really bad median incomes. They were really distressed, really deferred maintenance. I would have seen them and I would have said, I pass. So if you're looking at investing $100,000 with Gino, and I've got a deal, and this is the very first time you're doing it, why not get on a plane, fly down to St. Augustine, Florida, come tour my property, or at the very least, tour my office, speak to some of the people that are on my staff, because you're going to write $100,000 check. That's a lot of money. What does it take to spend a half a days of your time to go down and actually look at the property, get on the calls with the property management company, possibly speak to their syndication attorney, their cost segregation specialist, their asset managers, go through their operations, feel comfortable with them. And then when you do hit the jackpot and you find the sponsor, then you feel comfortable. Then there's legwork to be done in the beginning. You need, even if you're investing in stocks, you still have to learn how to read stock tables. You still have to know what a PE is. You still have to know what dividends are. You still have to know how to analyze a stock. Once you've done that and you feel comfortable, it becomes a lot simpler. But there does need to have some work done on the front end. Don't just say to yourself, what's the highest IRR? That's what people are doing. 20 IRR, boom, I'm going to send my money there. That's not how you invest. That's how you speculate, and that's how you gamble, and that's how you ultimately lose your money, and then you go and blame the sponsor on it when you should be taking a lot of the blame yourself.
Yeah. And hiring a consultant too, like a coach/consultant to coach you through how to invest passively in real estate. Again, this is, I think we're episode 268 or so, Gino. And like, I've never heard that before. Like, I've never heard that kind of coaching to passives. What I have heard before is bet on the jockey, which is what you said. And like if you vet the heck out of that sponsor and get on the phone, like you say, with their power team, their legal, their asset managers, their property managers, right? Their construction manager, talk to everybody that's working with them, get referrals, and really vet the heck out of the sponsor. That's really as far as the coaching around being a good LP goes that I've heard. Now, I know there's books that have been written. I think Brian Burke has a book on
yes,
being a great passive investor. And certainly you can't not educate yourself in that way, I wouldn't think.
Well, Tate, the important thing is, I think as a passive investor, I think you really need to know how to underwrite a deal. I mean, you need to understand, income going up 10% a year for the next 5 years. Is that reasonable?
Yeah.
I mean, expenses only going up 1%. Oh, right. By the way, why is a sponsorship group raising additional capital and then giving it back to me, calling it cash flow? What's that all about? You have to know these things. And I think if you can find a coach or a consultant, you're paying them $300 an hour, $500, whatever the number is. But if they look at a couple of deals and underwrite those deals for you and poke holes, and then you go back and you ask the sponsorship group, what about this stuff? And they go, ah. Well, they just saved you 50 grand or 100 grand. I think and for you to become comfortable, and that's how you learn how to underwrite deals. You're not out there going out and underwriting 100 different deals. You're just underwriting the deals that the sponsorship group sends to you. You're looking at that and you're trying to make sure that those assumptions are accurate. You're trying to make sure that when you're looking at it, what kind of deals are you investing in? Yeah. Are you investing in flood zones? Are you investing in median incomes? Do you have a buy rate criteria set up? These are all things that you need to figure out as a passive investor, and then find a sponsorship group that fits the bucket that you're trying to invest in. I think passive investors have a great opportunity to be able to diversify into different asset classes, different markets, different sponsors. They can do that, but they need to learn the business first, and they need to understand what their goals are. They could try to hit home runs with value adds. They can try to get, momentum plays and get some cash flow and get some, preservation of capital with these newer assets, but they just have to learn the business first and learn how to underwrite these deals.
Okay, so the fund to funds model is gotten to be very popular in this space, and I'm in a networking group, a mastermind, large mastermind format like yours. That's all about raising capital, and there are fund managers galore in this thing. Dozens and dozens and dozens of fund managers that are, a lot of cases it's a blind pool fund, right? So you're investing, your 50, 100, 250K in a fund that's going to be deployed into deals that, at least in a blind pool fund or in a lot of other fund structures, you're not going to really have any oversight. You might not even be educated on the deal. You're certainly not going to have decision-making rights once you're in the fund. Is there any room in your eyes as an LP, if you're coaching, a family member or friend, a close friend, or that is in it, they're like, hey, I'm looking at this fund. I love their thesis. I love their strategy. What are your thoughts on that?
Let me get this straight. I'm going to go give money to Tate. Tate has my money. He's going to go find somebody else that has a deal that I want to have the opportunity to look at that deal. Tate's going to take the money and give it to that person. For me, that doesn't work for me as far as the control that I have. And now I know a lot of people are doing it. I'm just not comfortable with that because I'd rather have Tate be on that team, bring me that specific deal so I can have that, because they may be even doing good deals. But let's say I want a deal that cash flows. But this deal's a build to rent and they're going to flip it in 3 years. But I want steady cash flow. That doesn't fit my model. So I want the control. I want to be able to vet the sponsor who's actually running the deal. And I want to be able to see the deal itself. So for me, that model doesn't work. It works for a lot of other people. But from what I've been speaking about, that's sort of giving your money away to somebody and saying, you know what, I'm going to go to sleep and hopefully this stuff works out. And I just don't sleep well if I'm doing that.
Yeah. Okay. So on the sponsor side, you're talking about a pretty special sponsor, right? Because the hypothetical Tate you just mentioned, I want to go invest. I want Tate to be the operator, the sponsor, the lead sponsor or the lead GP or whatever you're going to call it on this deal.
Yep.
That then becomes a sponsorship group that really, in my 5 years of doing this, what I figured out are you got to be good. You got to be really good, masterful at two different things. Really, I guess three different things, and this gets to your buy right, operate right, et cetera. Is you got to have a sponsor that knows what the heck they're doing with vetting deals, finding good deal, has a thesis that you're aligned with, and I'm kind of taking that for granted in this case, but they've got to be good. Number one at finding those deals, vetting them, doing the due diligence, putting in project management. This is, huge project management material here. And they got to be good at marketing and communicating with investors, which are, in my opinion, those that are really great and masterful at this, like you and Jake, for instance, like that takes a pretty special kind of cat, if you will.
We call it, we say multifamily is a team sport. Specifically to why you're saying this. And this is one thing that people need to understand. When you're first starting out, Jake and I, we started buying our own deals. We had our own capital. We started buying smaller deals. And that's where we started. We felt comfortable. We wanted a proof of concept. As we started to scale and started getting into syndication, we had to bring somebody on just for investor relations. Syndication's a different business than what we were running, because syndication has asset management fees, it has acquisition fees, it has investor relations, it has all those touch points. It's a different business. So if you're trying to do all this by yourself, you're saying, well, I want to keep the whole pie to myself. I get it, but you may be stretched thin, because if you're managing it as well, so we're vertically integrated. So we're managing this deal, we're property managing it, we're asset managing it, and we're doing investor relations. That's a lot of leverage you're pulling all at the same time. So it can be very, very challenging. And for those of you out there that say, hey, I'm vertically integrated, I'm managing my own properties, you should, put money with me. That's not always the case. Some of these guys that are managing their own deals aren't really good property managers. Maybe it may be good to get third party out there. But if you're going to do this, find a team, find someone who really likes to do the operations of the business, the asset management and or the property management. Find somebody out there who's really good at developing skills to find these deals, to put these deals on the contract, to get all the different vendors on board, right? And then the third component you'd mentioned, that whole investor relation aspect of it, because that is, and that's also somebody who's going to speak to your investors monthly or quarterly. We would have quarterly, when we first started doing our syndications, we would have monthly webinars talking about distributions, talking about CapEx projects, talking about what was next, talking about, hey, we've got a deal in the pipe. So you need somebody to handle that part of the business because you're always marketing for dollars. You're marketing for deals, but you're marketing for dollars. And you said, what makes a great sponsor? A great sponsor is someone who's transparent, who's authentic, who's always over communicating, and who's always listening to their investors. If you want to be a great sponsor or a great capital raiser, it's not about you. It's about the person sitting in front of you, having a conversation with them, getting to know their goals, getting to know that they're a good fit for you, getting to them to know that there's risks in real estate. And once they understand all of that and they understand real estate's a great vehicle, then you have the opportunity to pitch your deal or to offer your opportunity. Until then, you really should not be talking about deals. You got to get to know the person in front of you before you can start making any kind of assumptions on if they're a good fit or not for you.
Yeah. So somebody coming into the game, I got in 2020, 2021, we started buying our larger scale stuff. If I were going to go back and coach that guy now, it'd be a lot different than if I was coaching somebody coming in to the space right now. And I mean, multifamily is a team sport. That's something that's nothing new, right? And maybe that's what this market and this time is showing. I think your point is so well taken, that especially if you're going to be vertical, and you mentioned operations, property management, asset management, and then of course investor relations, monthly webinars, the value add stuff, the nurturing, the educational piece. If you're doing all that, it's not just you. And I would say if you're doing all of it well, it's not just you, right?
It can't be you because and we created the educational piece, Jake and Gino, to help us with the syndication business because it gave us credibility. We were able to do these live events. We started educating and teaching people, and maybe monetizing on education, but the monetization was second behind actually having that credibility and having those events and writing the books and speaking to investors and nurturing those investors. That part of the education really helped the syndication business. So Jake couldn't do that all on his own. He's doing the property management. So I'm doing the syndication / education business, and they work really well together if you can do it together. And then we had to hire somebody on to help us on with acquisitions, because it's hard to do acquisitions. You need to be speaking to brokers all the time. You need to be underwriting deals. You need to be going to these events. So you have somebody else helping you with that. But if you're going to start out right now, don't get overwhelmed. Just first couple of things you need to do is you need to understand that it is one of the best businesses on the planet. If you need to start small, you start with a 10 unit or a 20 unit. Don't worry about scale. Just worry about doing your first deal. Get your legs under you. Understand the business, take some bruises with the smaller deal. Then you either figure out it's not for me, or you're like, I love this business. How do I get my next deal? Then you start getting into your next deal. Don't worry about the 100 or 150 units down the road. Worry about what's on your plate right now. Focus on that. And then as these problems arise, you'll start diving deeper, going down those rabbit holes, going to events, meeting different people at different mastermind groups, different sponsors, different partners. Because when you're looking for something, it invariably ends up showing up when you're looking for it.
Yeah. Oh, that's some wisdom right there. A little drop of wisdom right at the tail end there. If you're looking for something, that's when you find it. That's you said it more eloquently than me. Gino, want to switch gears and talk about what you're up to in the thought leadership space. Specifically, you're writing a book that sounds amazing, or it might even be written. Is it coming out? Tell us a little bit about that.
I mean, the final edits are almost done. I interviewed a gentleman named Ken Honda about 6 months ago, and he wrote a book on happy money. That was the type of book. He sold 8 million copies. So at the end of the interview, Ken's like, he's Japanese. You need to write a book, happy money, happy properties, happy family. And Tate, I'm like, I don't want to write another real estate book. I just wanted to do something different. I want to be a little bit more broad. Multifamily is more niche. So I said, let me write a book called Happy Money, Happy Family, Happy Legacy. And I thought the reason why I need to write this book is I truly believe people with financial intelligence can change the world for the better. When the Pentagon can't account for 40% of its budget, and people are pissed off about a new change in regime, we have a serious problem in this country. We need to fix the finances of this country. We need people to understand income, expenses, but more importantly, we need people to understand their relationship with money. And that is the root cause of everything that I think is wrong with people when it comes to money. They don't understand their relationship with money. Are they savers? Are they spenders? Are they gamblers? And more importantly, why are they? And do they want to change? And I think we do things subconsciously or unconsciously from our childhood. The things we heard about money, it was scarce, or the things you didn't even hear or never talked about money. And you bring that into your adulthood. And as you're going into these investments, you see some people make a ton of money, then they lose it. They make it, then they lose it. What's going on there? Or they hate a certain candidate because he's a billionaire. Well, I hate him. He's rich. He's stupid. Well, do you hate him? Or you hate the fact that he's really wealthy? There's something that's going on there psychologically. And I think if we can understand our relationship with money, for myself, I was a big saver. Immigrant family, I was a hoarder. Saving is great, but at some point, there's a scarcity mindset. I don't want to let go of that money. Once I understood save the money to buy an asset that pays for my events, and I continue to have that asset. Once I understood that, and once I understood my relationship was, let me not be so scarce. Let me be abundant. Let me go out and grow the company, and let's have an education component where people are saying, you're going to teach people about multifamily and you're going to create competition for yourself. Well, that's the scarcity mindset of people talking about it. The abundance for me was, hey, I'm going to learn, I'm going to make some money doing it, and I'm going to really enjoy it. So go out there, understand what your relationship of money is today. Go back to your childhood. What did you hear? What were the people around you talking about? What kind of persona are you? Are you a saver? Are you a spender? Are you a gambler? Are you an avoider? There's a lot of people out there that avoid money, don't even look at it, and that's to their detriment. So that's why I wrote the book. And I think the last component of it is that legacy piece. Thinking about, years down the road, not only giving away and letting, passing down your financial gains, but passing down the values to your children, passing down, the social, passing down the intellectual property that you have, passing down the spiritual that you have. It's not just about getting rid of your money, but passing it down to the next generation, because they're going to be stewards. Because I think right now, I read a book by David Green, the guy who wrote Hobby Lobby, the guy who actually created Hobby Lobby. His family owns the company still to this day. And I'm reading the book and it really hit me. And what he said, and I truly believe this now to my heart, this stuff is not ours. Hobby Lobby belongs to God. And all of my assets, all of my stuff belong to God. And I'm trying to glorify God through what I'm doing. I'm trying to teach my children that. So the companies that we create, they really don't belong to me. But how do I become a steward of them? And how do I pass them along to my children so they can take care of it and they can not squander it? It's up to me. I don't want to leave them in a detrimental situation. I need to teach them. And that's what the book talks about. It's talking about how to pass the legacy, how to create a happy family, how to have these conversations, become authentic with your children, transparent, and to teach them about business, not to overwhelm them, but to teach them and to include them in those conversations. And if you don't do that, and all of a sudden your kids are in their 20s and 30s, and you're like, yeah, I'm going to leave you a bunch of money. Well, that's like by having a guy who buy a lottery ticket and win $5 million bucks. Well, what happens? A year later, they lose they're not ready for it. And then you blame the children. We're blaming our society today for our financial woes when it's never taught in schools, when nobody, there's no financial talk about anywhere. And that's the problem. So for me, I just want to educate people about starting the relationship with money, incorporating that with your family, and understanding that we're here for a short amount of time, and to have money create impact for others and to leave that legacy for the next generation.
Yeah. When I think of you, Gino, I'll just say this, and you're a from the heart guy, and I really appreciated that about you when I got to know you through your conferences and in your thought leadership, your podcast, and then having you on the show. It's just so evident that you're purpose driven, and you're heart centered. So I just want to thank you for that and affirm that in you. This to me, this particular issue is one that is particularly personal, I'll say. And so I'm just going to kind of throw my hat in the ring here in this conversation. And I'll just say, you and I came from kind of the polar opposite ends of the spectrum, in that I've historically, and I'm very consciously working on this and processing and going back into childhood journaling, doing a lot of visualization, meditation type stuff, Tony Robbins, NLP. I'm bringing it all to this issue because this is an issue that has caused a lot of suffering in my world. And I have been one of those, kind of feast or famine, guys financially. And when it's time to feast, it's time to spend. And that's coming from a place of, maybe this isn't so unlike you, but it's coming from a place of growing up with very, kind of almost schizophrenic messages, or that's not really the word I'm looking for. Very inherently disagreeing messages from my parents. One was that we lived in this beautiful house on a cul-de-sac in the suburbs of Cincinnati, great school district. We were on swim team. We went on vacations, blah, blah, blah. And yet at family meetings, which were fairly frequent, we were told that we were almost out of money, that we might have to lose the house and move somewhere else, which as a child is incredibly threatening and
detrimental.
Yeah. And I, for some reason, was a kid that was particularly afraid of change. And so something like that just hit me really, really hard. And I became, at an early age, became in love, 12, 13 years old, became in love with making money of my own so that I had control of it, so that I wasn't like in this dependence on a dad that had a business. He was a dentist, but he wasn't an entrepreneur. He wasn't and he would be the first to say that. And I love my dad, and he was a wonderful dentist, but they don't teach you how to do balance a budget or P&L in dental school.
Tate, this is important.
Yeah.
What you're saying is important because I'm going to take it a step further.
Yeah.
A lot of causes of divorce in this country are because of money.
Yeah.
I come from one background. My wife comes from a different background where money was never talked at. They never had money. So you put those two together and we're constantly arguing about money. We get married. Why are you going down the Whole Foods aisle with the organic produce? Do we need to spend $5 on a muffin? Well, she didn't really know about money. We got married. She stayed home with the kids. She was financially free when we got married. She didn't have to worry about money. Meanwhile, I'm the one who's a cheapskate, who's trying to save for the future. So you need to have these conversations. You need to understand what your blueprint is, and you need to understand what your spouse's blueprint is, and understand that there's no right or wrong. Yeah. We were completely different. And when I finally started having these conversations several years ago, it's not even that long. I mean, I wish we'd done it years ago. We got on the same page. I'm like, Julia, I just want to become financially free. I want to get this real estate thing because every time I get a bill for my kids' braces, I freak out. $5,000. Oh my gosh. I just want to be able to pay these bills. I want to be able to fly your mom down here to Florida on vacation, not worry about it. I want to be able to donate to the Friars and not really worry about it. And once she understood that, I painted the picture for her. She's like, oh, I get it now. So don't assume that your spouse has any idea of where you came from or what your fears are. Because if you go to your wife and you say, hey, listen, I'm really afraid about money. This is the fear that I come from. Like when I have some money in the bank, I don't want to waste it. I don't want to spend it. How can we be more frugal, or how can we create a budget? That I think your spouse will have a better understanding and will probably be more on board. So these conversations are important to have with your spouse early on because there's going to be conflict. So one of them might have come from a place of luxury where they expected everything, and another one may have come from a place of hardship where they didn't have anything. And those will clash. And if you don't have those conversations, it's going to be challenging.
Yeah. Yeah. And you're talking to a guy that's never been married, no kids. And I'm not so sure that that's not I'm not so sure that those are unrelated things, to be honest with you. And
you're having the conversation with yourself, Tate, and that's important.
Yeah.
Because I've done a lot of work as well. I mean, I've worked with a guy named Phil McKernan, amazing life coach. Go online and listen. What you're talking about is those are traumas in your childhood. I mean, everyone has traumas in our childhood. Some are greater than others. There's no such thing as a bigger trauma. A trauma of you as a 12-year-old hearing that your family may lose the house. That's a big trauma. There's a lot of fear in that. There's a lot of uncertainty to a little kid hearing that. You bring that into your adulthood, and every time you've got some money, you're like, hey, I may lose this tomorrow. I'm going to blow it. Well, you start making those connections. So that's why it's important to start going back into your childhood. What did you listen to? What did you hear? And let those emotions sit with you. I mean, it may take a little while to reconcile, but if you never go back to it, you're going to keep repeating the same mistakes over and over again. You're not going to know why, and you're going to be pissed off.
Well, and at least to my knowledge, neither you nor I are trained therapists, right? And
no,
I think some of this is kind of material for that sort of thing, because you hit on it just now when you're talking about going back and being with the feeling, and you mentioned it might take a second to kind of integrate or process. It might be a process, I think is what you said. And,
yes,
and that to me is the key. That's kind of, that's where I've spent the hours in YouTube and with Tony Robbins and his coaches and NLP and trauma therapy, like, looking at healing trauma, right?
Yes.
I mean, and you use that word, and that it's nothing short of that. And, when you talked about, with me and my family and I'm getting emotional about it now. I can literally see my parents. And I don't know whether this actually happened or this is just energetically how it feels, but just way, way, way up above me. And I'm sitting down here as this little tiny kid, and we're at a table, and they're saying that not only is there instability and insecurity and even crisis, but it was being shared with me in a way that I took it anyway, is that I needed to do something about it.
That's how you took it. That's your truth. That may not be the truth.
Right.
And the worst part about it is you may be saying to yourself, man, my parents let me down. And as an adult, as you get older, you feel bad about that, because you're like, how could I criticize my parents? And that's a bad feeling for a little kid. But your parents didn't do the right thing by you when you were young. And it's okay. And we have the guilt and that denial as adults. And that's something you need to work through. And that's why therapy is good. I love therapy. We need to be able to look back. Just don't get stuck there for the rest of your life.
Right.
I like coaching as well, because coaching sometimes doesn't look back as much. We're always thinking about the future and go, rah, rah, rah. I think a mixture, I'm a life coach. I love life coaching, but I think a mixture of both of those will really help out. Let's go back. Let's sit back in those emotions. You need 6 months, 8 months, a year to really figure that out. But as you're figuring all that stuff out, live in the present and start working with a life coach as well to see what your future looks like. Do both of them.
Yeah, I love that distinction you just made between therapy and coaching, because I've been I was a psychology major. I did a lot of therapy and dealt with a lot of anxiety, depression in my teens and 20s. I'm in my 50s now, so it's luckily there's been healing around all of that in the past, but that involved some therapy. It involved some alternate healings and spiritual stuff and et cetera.
It's a constant journey, Tate. That's the thing. I don't think, and there's nothing to fix. You're not broken. I'm not broken. We just have certain issues that we have. And it's okay to say, hey, I had a rough childhood. I mean, whenever you ask somebody about their childhood, it was great. Oh, it was awesome. My childhood was great. But certain things happen that suck. People used to make fun of me when I was fat. I mean, it's okay. But if we don't at least admit that and work through that, my mom would always yell at me for no reason. She's an Italian who had a shoe. That shoe would go flying often. I was the brunt of that. She did the best that she knew. But that wasn't the best for me. And I felt the guilt of that, of carrying that into my adulthood. Now, do I parent my kids that way? So there's that other issue as well. So you're trying to reconcile all of this. And we're talking about multifamily here. Can you imagine where people are out there? They have all these beliefs. They have these beliefs about money. They have these beliefs about themselves, and they're trying to do a deal. You're not messing up because of multifamily, because any monkey can learn how to do a cap rate, and any monkey can go out there and raise capital. The thing that's holding us back the most, in my opinion, is ourselves. Once I figured that out and I went to coaching school, I went from 30 units to 500 units in 3 years. The only difference was my mindset and my ability to say, hey, I'm the problem here. How do I solve myself? How do I fix myself and heal myself and say, hey, I deserve more. Why do I only have one restaurant for 20 years? Then all of a sudden, within 5 years, I started working on myself. I started working with the Tony Robbins out there. I started working on my mindset. I started working on the coaching aspect of it. And all of a sudden that bleeds over from the personal, it bleeds over into the professional life. And you start taking risks and you start taking, chances, and you start going out there, finding partners, and you feel more confident to talk to brokers, and you feel more confident about putting offers in. And then all of a sudden you're going out there and you're talking to investors. I'm an introvert, but all of a sudden I'm out there talking to investors and I'm raising money, and I start a podcast and I write a book. That just doesn't happen coincidentally. That happens because I've been on that journey, and I want everybody to be out there. You deserve to be on that journey if you're listening to this. We were created for something greater than a 9-to-5 job. We were created for impact. That's what we were created for. And I'm just using multifamily, and I'm using my family as that impact to help others.
Yeah. And if you're listening to this, you're definitely one of those that Gino's just talking to. Not everybody listens to podcasts like this, and if you're hearing this, you attracted this. I promise you did. And what Gino is preaching is I know it. I've lived it, and am living it. I'm very much working through. And I do want to just highlight one thing that you said, because I think there's an opening for not just compassion, but also forgiveness and healing. And that's it. That is that, your mom was doing the best that she could with what she had.
That's right.
My dad was doing the best that he could with what he has. He still is, and it's okay to say that it sucked.
Yes.
And to almost, Tony Robbins talks about embracing the suck. That's kind of been a long way to get around to that for me. It's okay to say, you know what, I love them and I know that they were doing their best, but it sucked and it hurt me, and it's affected me in big ways, and
yes.
And then, the compassion that hopefully you get access to for them, and also for yourself, for the kid that sat at the table, or for the kid that had the shoe thrown at him. That to me is I feel like I've accessed that space of compassion for all, compassion for me, compassion for my heart, compassion for Gino's heart and his family and his people, and that we all in one way or another had shoes thrown at us, or thought we might lose the house.
Tate, I'll end with this.
Please.
I think what most of us really lack, I don't want to say most of us, because I don't want to generalize, but a lot of us lack self-love. I mean, if we really loved ourselves more, and for myself, I can speak for myself. I'm so hard on myself sometimes, and I beat myself up sometimes, and that's great. It's great to motivate myself. But sometimes my coach told me, "Hey, you got to be a little more compassionate to yourself. You're an okay guy." And why am I doing that? Do I love myself? Sometimes that's probably part of the issue, is I have some of that, and I don't use the word self-loathing, but some of that stuff that happened to me years ago, I'm still holding on to that a little bit. So I'm not showing as much self-love and as much compassion to myself. So for me to show you compassion, I think I need to show myself some compassion first before I can show compassion to others. And I'm really telling you, the good book says, love thy neighbor as thyself. I mean, if you don't love yourself, it's going to be really hard to love your kids or to love your spouse. So you have a duty to go start tapping into some self-love, because let me tell you, once you can feel comfortable in your skin, once you can feel comfortable with the silence, once you can feel comfortable with yourself, it starts showing. It starts showing up in your life in other ways. And then all of a sudden you'll start making those connections, and you use that word compassion and not judgment. That, when you go out there and you start judging others, why are you judging them? I do it because I judge myself so harshly. Sometimes I do that to others, but look within sometimes. And I think that self-love and that compassion, if you can have a little bit for yourself, it goes a long way.
Yeah. And to me, it's all about the language that we choose to talk about ourselves, talk about others. And if you're ever throwing yourself under the bus, even because you think it's funny or polite or the thing to do socially, just notice that.
Yes. Yes.
Don't
your language becomes your experience.
Yeah.
That's
totally.
the reality. If you want to get into real estate, what are cap rates? What's a cash on cash return? What's IRR? Yeah. If you start and it's just a joke, and when you're married, you say, "Hey, my better half." Well, she's your better half. That means you're devaluing yourself. That sounds like great. You're giving somebody else a compliment, but once again, what does that truly mean? Are you demeaning yourself? Are you belittling yourself? Happy wife, happy life. I used to think that was great, but I have to make my wife happy to have myself be happy, that's pretty inverted. And that's pretty, you really stop and think about that. That's really an insane comment. You're not there to make your wife happy. You're there to make yourself happy. And then out of your joy, it'll exude into the relationship.
Gino,
bet you didn't expect to listen to this. Bet you expect to hear this on a Multifamily podcast, huh?
That's right. Yeah. I mean, we go a lot of places. This has been a beautiful conversation. I really appreciate you. I can't wait to read the book, man. I'm so excited. I've had Ken Honda's book for a while, and man, if you putting your Gino touch on that, or in that space will be awesome. I can't wait.
You get a copy, brother. No problem. It's out.
Thank you so much, Gino Barbaro. Thank you, listeners. Love you guys. Appreciate you hanging out with us one more time. We'll be here next week. Take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.